Good morning, everybody, and thank you for joining this 30-minute call to discuss our agreement to sell the majority of our PTIC businesses. I'm David Bishop, Investor Relations Director, and I'm joined this morning by Jez Maiden, Group Finance Director. Jez will take us through a 10-minute presentation, and then we'll have 20 minutes for Q&A. If you'd like to ask a question, please submit it in the box below. You can also use the raise hand function in Zoom. All those submitting questions will be able to ask them on screen at the end of the presentation. I'll now hand over to Jez.
Thanks, David, and hello, everybody. Thanks for joining at such short notice, particularly at this busy time of year. I'm sure you've seen our announcement this morning, and needless to say, we're very pleased to have signed a definitive agreement to sell the majority of our performance technology and industrial chemicals, or PTIC businesses, to Cargill, the largest private company in the United States. The businesses we're divesting represent 77% of PTIC sales in 2020. The parts of PTIC we're retaining that will provide integral support to consumer care and life sciences will become our Industrial Specialties sector, which I'll talk about shortly. Cargill have agreed to pay an enterprise value of 915 million euros, approximately 778 million pounds sterling in cash, for the divested business on a cash-free, debt-free basis. This represents an attractive multiple and reflects the quality of the business and the high levels of interest we've received. The divestment follows the strategic review of PTIC that we announced in May 2021. You'll remember that the purpose of that review was to determine the best ownership structure for PTIC to ensure its future success. We're pleased that in Cargill, a company with a 150-year history and over 150,000 employees in 70 countries, we found an acquirer who is well placed to invest in the business and take it forward. We're already working with Cargill on the process to separate the two businesses and expect to close the transaction in summer 2022. Completion is subject to customary regulatory approvals, but does not require the approval from shareholders. Most significantly, the agreement we've announced today completes our transition to a dedicated consumer care and life sciences company. We'll focus our capital and resources on scaling our healthcare technologies and further developing our position as a sustainability leader in consumer care and crop care markets. This will enable consistent sales growth and even stronger profit margins. I'll talk about the use of the proceeds at the end of the presentation, but before I do, I'd like to step you through the financials, both the shape of the divested business and its impact on Croda. On the following slides, I'll focus on full year 2020 numbers, but we've also provided performance for the 12 months to June 2021 on each slide. You will recollect that at the end of last year, we transferred our home care business from performance technologies to consumer care. The 2020 disclosures in this presentation have therefore been restated for the earlier change in sector reporting, consistent with the approach we took in the half-year results in July. While the agreement with Cargill is denominated in euros, the information on the slides that follows is presented in sterling. This slide shows Croda's reported performance in 2020 on the left-hand side and the divested business on the right for the full year. As the divested business does not exist as a separately reported entity, these results have been derived on a carve-out basis from PTIC's performance. This includes the full value of the trade, which in future will be shared between Croda and the divested business under planned supply agreements. The divestment we announced today covers both performance technologies and industrial chemicals, which have been separately reported in the past. In full year 2020, and as reported in our last set of accounts, total PTIC sales were £470 million, and total adjusted operating profit was £49 million, an operating margin of just over 10%. The depreciation and amortization charge in PTIC, presented on a consistent adjusted basis, was £25 million. Of this, divested business sales were £361 million, representing 77% of total PTIC sales. This is in line with our previous expectations about the proportion of the business that could potentially be carved out in a divestment. This includes approximately £35 million of sales for Croda SIPO in China, a joint venture in which we have a 65% stake. Today's sale is based on 100% of SIPO transferring to the buyer, which we will now explore with our JV partner. In the event that this sale cannot be achieved, we will continue to run SIPO as a JV, and it will reduce the consideration by €140 million. Finally, total adjusted operating profit for the divested business in 2020 was £39 million, and the D&A charge was £12 million. This next slide shows gross assets for the divested business in relation to PTIC as a whole. In 2020, combined assets for PTIC were £614 million, or £564 million excluding home care. Gross assets for the divested business were £320 million, approximately 57% of PTIC. The divested assets comprise 5 manufacturing facilities, including Croda SIPO, Gouda in the Netherlands, Hull in the UK, and 2 smaller European sites, plus 2 additional laboratories. Gross assets as a proportion of PTIC is lower than the equivalent proportion of sales because we've retained the highly integrated sites, such as Atlas Point, to support the future growth in our focus sectors. The next 2 slides explain the divestment, the impact of the divestment on Croda and the new Industrial Specialties sector, the part of PTIC that we're retaining. First, let's look at PTIC and Industrial Specialties. Taking the combined PTIC sales in 2020 of 470 million as a starting point, the carve-out will reduce sales by £361 million, as stated previously. We've put in place a supply agreement for these products for those areas needed by the buyer to meet the requirements of customers, but which are manufactured on retained Croda sites. Similarly, there's a supply agreement to provide certain ingredients to Croda from the divested business's manufacturing plants. These agreements will be managed by our new Industrial Specialties sector alongside the retained parts of PTIC, and would have generated £63 million of additional revenue to Croda in 2020 had they been in place at that time. The overall impact of the divestment is therefore to reduce PTIC sales by £298 million. The new Industrial Specialties sector would have had £172 million of sales in 2020 had the divestment been in place at that time. This second slide summarises the overall impact on the group. From the previous slide, group sales would have reduced by £298 million in 2020, and the divestment would have reduced operating profit by £36 million. Note, this is different to the divested business profit because the impact on Croda takes account of both the value we retain under future supply agreements and dis-synergy costs remaining with us, which were previously allocated to the divested business. As you would expect, with an increased focus on higher value markets, the return on sales for the group would have been almost 3 percentage points higher as a result of the divestment. In summary, this divestment will allow us to focus our capital and resources on higher growth markets. Our priority is to reinvest capital released through the transaction into organic capital expenditure to take advantage of the significant opportunities we see for growth. Our focus is on increasing our exposure to healthcare and further developing our position as a sustainability leader in consumer care and crop care markets. This will be supplemented by potential acquisitions of disruptive technologies in both existing and adjacent markets. Clearly, the proceeds of the sale will significantly reduce net debt in the short term, which is net debt is expected to be just over £800 million at the end of 2021 prior to the divestment. We maintain our long-standing capital allocation policy and will return excess capital to shareholders if leverage remains below our 1 to 2 times EBITDA target and sufficient capital is available to fund investment opportunities. But our priority is to reinvest these proceeds in the growth of the 2 focus sectors. So in summary, we're confident that our talented and hardworking employees in the divested business can look forward to a bright future under Cargill's ownership. The retained parts of PTIC will play a key role in our integrated model, forming the Industrial Specialties sector. The divestment will complete our transition into a pure-play consumer and life sciences company, with well over 90% of profits expected to be derived from these two areas. And the sale will facilitate focused investment into faster growth markets, delivering consistent sales growth at an even stronger profit margin. Now I'll hand back to you, David.
Thank you, Jez. We're now happy to take your questions if there are any. As a reminder, if you do have a question, please raise your hand or type your question in the box below. Matt, the moderator, will then invite you to unmute your line.
Hi, good morning. Thanks for doing this call. Merry Christmas, first of all, everyone. I have a few questions, please. First of all, on the SIPO divestment, what are your discussions with Sichuan, your partner in that joint venture? And could you put some, at least, verbal commentary around the likelihood of a SIPO divestment as part of the deal? And connected to SIPO, why has SIPO become so much more valuable? You acquired your stake in 2013, and it was 69 million euros on a 100% basis, and this has now doubled. So could you share some financial figures of how that business has performed, what the sales and earnings level of SIPO is right now? So that's part one. Secondly, any synergies that you expect from the divestment? And then lastly, can you just talk us through what is retained exactly in the business? What's in the 23% that are not being divested, please? Thank you.
Yeah, hi Gunther, and yes, thank you. Wishing everybody a Merry Christmas. That's a good way to start the questions. Yeah, I mean, clearly up to now, the discussions have been primarily between ourselves and Cargill over the purchase. And so, you know, now obviously we've got a period of several months before closing can happen, while the sort of regulatory approvals and so forth are processed, and we finish the separation work really around how to carve the business out, given that it's not a sort of standalone entity. And during that time, we'll be able to have discussions with our joint venture partner in terms of you know, whether or not yeah, they're happy to be a seller as well as part of the assets. As I say, the fallback position is that we will, you know, the fallback is that we continue to run it as a JV, but clearly, given that SIPO has a strong crossover with the products that particularly come out of Gouda and Hull, you know, it would make sense to us to dispose of all of those together. So we'll take those discussions forward over the next few months. In terms of value, look, I think you know, this business has more of an industrial focus, obviously, than the other two sectors that we're focused on. And I think, you know, if you look at where growth is coming from in industrial sectors, you know, the vast majority is being driven by China, either China for the best domestic consumption, or China as a manufacturing location for the rest of the world. And I think it's well over 50% of the future growth in industrials is expected to come from China in one of those two routes. So for that reason, I think, you know, having a manufacturing presence in China, as well as the lab that we opened last year in Shanghai, which is part of this carve out as well, and the sales force that we have in China is really quite attractive to global companies like Cargill that want to grow their presence in China and already have a strong presence in China. So I think that's why you're seeing more value related to China. David, did you want to touch on the rough broad parameters around the scope and size of SIPO?
Yeah, Sure. So I think you also asked Gunter about what's actually in the business that we retain. So I'll
Yeah, I was going to come to that, but you go ahead and answer that one, and I'll come back to dyssynergies.
Yeah. SIPO is about 35 million pounds of sales. So that's the rough scale of the entity that we have the stake in China.
Do you want to touch on the retained part of Industrial Specialties, what's in there, David, and I'll cover dyssynergy.
Yeah. So as we've said in the release, you know that we run an integrated model at Croda, and a good example of that is our Atlas Point site in the US, where we produce bio-based surfactants for industrial customers as well as customers in consumer care and life sciences. So the retained part of Industrial Specialties is there to support consumer care and life sciences. In terms of specific standalone industrial capabilities, we have a fibre and fabrics business in there, which is mainly capabilities in India and Indonesia, serving the textiles industry. We have a water treatment business, and then we also have what we're calling a smart formulations business. So these are the higher growth elements of the portfolio, focused on electronics and display technologies, for example.
So I think in there, Gunter, you've got a good mix of businesses which are actually quite hard to separate from sites that we want to retain within Croda, and businesses where we see some specific targeted strategic opportunities, but which don't then obviously compete with the business that we're selling and so forth. So that combination together makes sense, because those product areas, support the cost and investment around the two focus sectors, and also makes sense to sort of, because they're different businesses to the primary, the energy technologies and the smart materials businesses, which form the key basis of the businesses that we're selling through the divestment. In terms of the dyssynergies, it's a relatively small cost overall. Clearly all the costs are related to manufacturing sites, all the costs relating to sales, marketing, and the R&D teams are expected to move as part of the transaction. So really, what that leaves us with are some costs in our regional centres. So overhead costs associated with running regional operations, together with some central costs that would have been previously allocated to the business, but which, other things being equal, clearly don't really change, and which would then fall back onto the remaining sectors. I think that's a relatively small number. It's also a bit of a transient number, because of course when we added Iberchem and Avanti in 2020, we didn't increase those regional overheads and central costs, so they got spread over a larger value add base. And so yes, we'll get a short-term temporary negative impact from dyssynergies, but of course as we grow, those businesses will absorb those costs. So essentially the costs that are not variable with what we do in the divested business.
Thanks. I'll jump back in the queue.
Okay, thanks, Gunter.
Thanks, Gunter. Any further questions?
Well, I could shoot another one if no one else has any.
Looks like Charles is just coming through. So Charles Eden at UBS, go ahead and ask your question. Good morning.
Yeah, morning. Thanks both. Just a couple additional ones for me, please. Firstly, just is there any tax implication of the disposal to note? That'd be the first one. And then, Jez, if I could just pick up on your comment, I think it was slide 8, where you said obviously primarily organic investments, but supplemented by potential acquisitions of what you refer to as disruptive technologies. Would you be able to elaborate what would constitute a disruptive technology, please? Thank you.
Sure, absolutely, Charles. In terms of tax impact, the principal sales in the UK and Holland, which are the big operations, then not expected to have any significant impact in terms of tax leakage, if I could focus on that piece, because of the UK and Dutch legislation around that. There will be some limited leakage associated with sales of sales office and potentially a small amount in China as well, but the tax leakage is relatively small on this. Because of the UK and Dutch exemptions. And it doesn't really change the geographic footprint going forward if you're also thinking about effective rate of tax going forward. So we wouldn't expect that to change away from our sort of general guidance of around about 25% for the effective tax rate for the group. You know, it's got a fairly typical global footprint for us in terms of mix of presence. In terms of investment, look, right now, I think, you know, we see a lot of organic investment opportunities, which is why we feel the focus will be there. I think we have a good model that we've demonstrated through the healthcare process platform over the last 2 or 3 years. You know, we had the technology platform in patient healthcare on specialty excipients, so the liquid injectable delivery systems, which has grown up in Croda over the last 10 to 20 years. And we've been expanding that organically with doubling of capacity in the US site to meet the sort of 10 to 30% growth that we're seeing in that platform year on year. And then we, 3 years ago this month, we did the acquisition of Biosector, so the vaccine adjuvant business. And since acquiring that for about 70 million euros, we've probably invested about 20 million pounds so far in expanding capacity on the existing footprint. And then we bought Avanti for, up to 260 million, including the earn-out dollars. But what we've then done is we've invested, 40 million in that site and 40 million in the sister site that we already have in the UK to expand the capacity and capability. So I think that's quite a nice model there, which is to acquire a platform technology through M&A to sort of shortcut into that technology, but then to expand it organically. So I think we can look forward to a period of the next 3 years where we can see enhanced opportunities to deploy capital organically to expand the footprint we have in those 3 platforms, in crop care and in consumer care, as we showed with the Parfex and Alban Muller acquisitions earlier this year. But then if we can identify another platform in healthcare, in patient healthcare, in delivery systems, if we can identify things as we did in crop care, where we did Incotec and Plant Impact previously, or in consumer care, where we've obviously done Iberchem and the related acquisitions, I think that's a really good model. So I think what we're saying is primarily, I think we have a great footprint and therefore we want to organically build it out. It's lower risk. You're not paying a multiple, you're not paying away goodwill and intangibles in that. The risk is more managed from that point of view. But periodically we will find a new technology, a new platform to get into. And I'm sure in healthcare, for example, I'm sure that there may well be a 4th or a 5th platform that keeps us in delivery systems. That's where we're focused, but which would allow us to then grow and scale out from that. But once we've got a platform, we prefer to develop organically. And I think that's proving a very successful model in health. So I think that's the structure you can see. So more inorganic, but these sort of bolt-on acquisitions from time to time. As we know, the sort of Iberchem scale acquisitions, 820 million euros this time last year, they are quite few and far between. So I think the Avanti Biosector type of acquisition is more likely to be the scale of M&A, but you wouldn't rule out, but there are very few examples of bigger businesses, and they tend not to be available very often unless they're already private equity owned, like Iberchem was. So I think that's the structure we see going forward. A bit more organic, an opportunity to deploy more organic spend, I think, over the next, say, 3 years to expand the footprint that we've got now and sustain the stellar growth that we've been seeing. And then let's look for additional opportunities, and that's our priority for using the proceeds.
Understood. Thank you both.
Thanks, Charles.
Thanks, Charles.
I think we have one on chat as well, David.
Say again?
Just to keep an eye on chat. I think there's one on chat so far as well.
Understood. Well, why don't I briefly cover that? So it's Adam Collins at Liberum. He's asked, can you say more about the PTIC retained business? What's the pro forma growth and margin for that business? I'll touch on the margin, and then perhaps you want to talk about growth, Jez. So broadly, the retained business, we think will have a return on sales in line with PTIC. So that's Performance Technologies and Industrial Chemicals combined, which as a guide was about 10.3% in FY20, and then 11.1% on the last 12 months to the 30th of June. So that from where we are today is a reasonable guide for the likely margin for Industrial Specialties. Jez, anything to say on growth?
Yeah, so our perception on growth overall for the more industrial focused businesses was that these are primarily a global GDP type play, and I don't think we'd move away from that in relation to the fibre, the formulation, and the water treatment businesses that David talked about. So I think that sort of GDP type growth levels in the absence of raw material price inflation is probably a good guide. Also, Adam, picking up your other point. So the big sites within the group which are going as part of the divestment are Hull, Gouda, and SIPO. And there's a couple of little satellite sites in Europe which have been primarily focused around recent technologies that we've acquired. The other sites for the group are not part of the divestment, although they may supply limited amounts of product through the supply agreements that we talked about. So the big sites like Atlas Point, in the US, are not part of the divestment. We're keeping that probably becomes one of the group's largest sites following the disposal of Gouda. So yeah, that site and all the other sites in the group are not part of the deal. Will stay because of the integrated nature of the group. You might have some products, e.g. some surfactants made at Atlas Point, which will be sold to the buyer as part of the deal, as part of the supply agreement. So we might continue to make product for them. But one of the reasons we've retained the water treatment business in Industrial Specialties is that business is quite heavily based on our surfactant chemistry. So clearly, surfactant chemistry is the commonest chemistry across the group. We use it it's used in cleaning within home care, cleansing the body within personal care. It's got applications in crop care, and of course, it's also sold into PTIC. Primarily, for example, into the oil and gas industry for fracking and so forth. And so the water treatment business is basically primarily supplying into oil and gas. And that business will be retained because it's based around the surfactant chemistry at this point. So we'll keep that.
Thank you, Jez. Thank you, Adam. We're just going to go to Mubashir Chowdhury at Citi first, and then come to Sam.
Hi, thank you for taking my questions. Just a couple. So if I understand correctly, the cash inflow should be very similar to the 780 million that you've talked about today, because you said there's a relatively low cash leakage. So I know you talk about organic opportunities, but then you talk about kind of the 20-30 million being invested in different sites and different business that you've kind of acquired. So it's quite a large number to deploy organically. So I'm just trying to get to is it fair to assume it's going to be largely inorganic in terms of deploying this inflow? And are you giving yourself a timeline where you run a slightly inefficient balance sheet such that as and when you find a deal you'll execute, otherwise this will come back to the shareholders? So just wanted to get some thoughts on that. That's my first question. The second question, Looking into 2022, I just want more of a clarity. I think previously Croda's talked about potential margin expansion into 2022. I just wanted to double check that and say, on a like-for-like basis, including now PTIC sold in 2021, is that margin expansion comment still relevant on a like-for-like basis? And finally, from a portfolio perspective, including the remaining industrial specialties and the rest of life sciences, are you kind of happy with the exposure and the setup of the portfolio that you've got at the moment, or should we expect further kind of, obviously on a smaller scale, but further trimming and pruning of your exposure and your portfolio setup? Thank you.
Okay, thanks, Mubasher, for that. Yeah, so yes, you're right. So yeah, most of the proceeds would be expected to flow as cash, because you say there's relatively limited leakage there, and there's limited debt within the businesses that are being sold, etc. So yeah, that will come through. So based on just over £800 million of net debt at the end of this year as a forecast, then it's going to not quite fully eliminate it, but obviously mostly remove the net debt. So we'll be in that position of close to zero leverage. Obviously, once the deal completes, which, as I say, we expect to be in summer 22. Really, I go back to my previous answer. We do see an opportunity to increase the organic capital spend for a period, let's say 3 years, to deal with to take advantage of the opportunities that we have in the consumer care and the life science space right now. We don't think the structural level of capex is changing. We think that stays around about 100 million, 5 to 6% of sales. There's nothing unusual in the capital footprint of PTIC which would distort that. So we expect to stay around that level. But I think we can put a decent amount more capital to work in terms of accessing growth, which will mean that in the medium-term growth rates in both consumer care and life sciences are enhanced relative to where they would otherwise have been. But you're right in terms of saying that, look, with the cash generative nature of the group and so forth, with our dividend policy, that's not going to use all of the proceeds that we would anticipate here. So I think that we do see inorganic expansion as part of the story, as I laid out. I think it's a good way into new platforms and new technologies. But it isn't just putting it all there, and therefore that's why we remind everybody that we have a very clear capital allocation policy, which we put in place 7 years ago, and which we have operated, which is that we've done two special dividends as returns of capital to shareholders, and of course we've done one equity raise around the Iberchem. So we are very disciplined around our allocation of capital. And if we don't see applications for capital, then we'll return it to shareholders. But at the moment, and certainly based on the feedback we've had from investors over the last few months and indeed years, we've got such good returning opportunities in these markets that actually, if we can find ways to deploy them effectively, we should definitely do that first. However, we have a very clear discipline, very clear about the returns we expect from our projects, both organic and inorganic. And if we're not seeing those, then of course we will consider returning the shares. So yeah, there's going to be a period, probably, unless we're very fortuitous in terms of timing of things, where from the middle of 22, yeah, you might call the balance sheet a little inefficient. But I think it's as we've shown in the past, opportunities do come up. We invested nearly £1 billion in 2020. At a time when everybody else was really diverted by the negative impacts on their businesses of COVID, we were able to move quite strategically, and we expect to be able to see more of those sorts of opportunities. So yeah, might be some short-term inefficiencies, but we're always managing for the longer-term value creation that we can bring from that. In terms of 2022 margin expansion, yeah, I don't think anything changes there. I mean, clearly there's a step up because PTIC has obviously always been dilutive to the margin that we're achieving in the business overall, and therefore there's a step up from that. But yeah, we would see opportunities for margin progression. I think, you know, we're currently mid-20s margin in consumer care. We think that there's definitely opportunities to increase that. I think that will depend on the mix. Clearly, if more of the growth is coming from Iberchem, which has an inherently lower margin per the flavors and fragrance industry average, then clearly that's a little dilutive. But I think the fact we've got nearly 50 million euros of sales synergy that we expect to deliver by 2025, and the fact that we're seeing good growth in the actives and beauty care areas of what we used to call personal care, excuse me, together with the improvements we expect in home care performance, we expect the consumer care margin overall to be, you know, accretive, you know, over time. And in life sciences, you know, although this year is probably a bit of an exceptional year because of the way we've needed to deal with the sort of COVID-related demand that actually has had, as we said at the half year, a bit of a short-term benefit to margin. We will, you know, we do expect life science to be, you know, mid-30s type of return on sales business, and opportunities, particularly through healthcare, for potential expansion. So don't change our guidance at all on the opportunity for not just this step up in margin because of the maths, but also the move forward in margin while also delivering strong top line sales. Look, I mean, the portfolio at the end of the day, I mean, we're really pleased with. We think that a pure play consumer care and life sciences business is the area to focus on. The industrial specialties area is a good supportive area, that combination of hard to separate businesses, but also businesses that we think are worthwhile in supporting the other two focus areas going forward. And we're comfortable with the legs that we're in. We think there's a lot of opportunity to deliver growth in consumer care, in healthcare and in crop care. We don't need to step outside that area for us at the moment to deliver strong growth and really good returns.
Thanks, Mubasher. Samuel Parry, Credit Suisse.
Hi guys, thanks for taking my questions. A couple. Firstly, does this divestiture disadvantage you at all from a raw material sourcing perspective? And then sort of following on from Mubasher's question, on the CapEx, my understanding was that the projects you're already undertaking in life sciences and specialty excipients were sufficient to drive the level of growth that you targeted and all the opportunities you saw. So where's this additional CapEx going? And then thirdly, on a special dividend, can we assume that, given that there's not one announced in conjunction with this announcement, that it's unlikely to happen? And what was historically your criteria for paying a special? And then lastly, just from a modelling perspective, when will you be reporting under this new structure?
Thanks for those, Sam. In terms of raw material sourcing, no, it doesn't disadvantage us at all. Probably the largest single raw material usage in PTIC is rapeseed. So clearly we won't be buying, you know, sort of rapeseed or very much rapeseed going forward. But then if you look at consumer care, you know, the dominant material is palm oil derivatives and so forth. So we're still buying a large basket of commodity materials, and that doesn't change. So no, certainly don't see any disadvantage on raw materials from that point of view. Performance Tech is a relatively high bio-based content. So our average bio-based will come down slightly, probably more into the 50s from the current 65% bio-based, but we still believe we can get to our target of 75% of our raw materials being bio-based by 2030. So we're not moving that target, even though this makes life a little bit tougher from where we start from. But the direction of travel in consumer care, in particular, is very much towards more bio-based materials. So, you know, the growth of plants like Eco in Atlas Point on bio-based surfactants is just a great example of where we're moving the consumer care markets towards more sustainable ingredients. So we have no concerns over that. Yeah, look, this, I think, in terms of CapEx, we're already on that journey in terms of an elevated level of CapEx. You know, we've guided, you know, generally I'd expect CapEx this year to be, in 2021, to be of the order of 150, 160, whereas actually in a normal growth, you know, period that we've seen over the last decade, for example, probably 100 million is sufficient to replace the asset base, invest in solid growth, and do what we want to do on the carbon agenda, on the sustainability agenda with decarbonisation of plants. But this year we're probably going to be 150, 160, and that's really about these additional opportunities. 40 million pounds invested in the UK lipid facility, 40 million pounds invested in the Avanti lipid facility as probably the big drivers of the spend this year. But I think that when we look at businesses like Avanti, there's a whole new set of opportunities. There's attached to the lipid technology that we've bought there, which is currently very COVID orientated, obviously, but will increasingly become more mRNA, gene therapy, therapeutic drugs, and vaccine, but non-COVID orientated. That's what we bought that business for. That will drive going forward. And right now we're producing 4 lipid ingredients. There'll be a broader range of ingredients added in the same way that we've moved from probably half a dozen specialty excipients to well over 50 now, and that's broadened the drug portfolio that we can meet. So I think that there are more growth opportunities that we can focus on for the medium term around that platform, and as fast as we invest in vaccine adjuvant capacity, it's sold out. It's so the opportunities to grow in that business and in consumer care as well. So that's what I mean about, I think we've got an opportunity to take some superior growth by investing some relatively modest amounts of capital relative to what you might spend on an acquisition. And so that's why I think we can probably have a sustained higher rate of CapEx for maybe a 3-year period without actually changing the basic fundamentals of the business, which is a relatively capital-light business. In terms of special dividend, no, I wouldn't. I mean, it's not unlikely, but this is not a transaction to divest of a business and return the proceeds to shareholders. There are great growth opportunities, and we're talking about, we're looking at returns on capital, for example, in the life science business, which are about 3 times the cost of capital. So it would just make no sense for us to return the proceeds to shareholders if we can reinvest it for them and generate returns which are 3 times cost of capital. And that's been, for me, the strength of the Croda story, the fact that we can maintain these higher return on capitals and not suffer mean reversion. So our job is to keep finding these opportunities and to invest them. But it's great to have a capital allocation discipline and to say, look, if we don't see those returns, we're not chasing a marginal return. We're not putting more capacity in and chasing marginal pricing to get more volume. This is a value-based investment thesis, not a volume-based investment thesis. And therefore, it's a very good discipline internally and externally, I think, to have the return of capital. But we wouldn't be looking at a return of capital on the immediate back of the divestment. We'd like to see what are the capital opportunities to redeploy. And then if we've still got surplus capital, as we might have in that process, then of course we'd look at return either through a buyback or a special divvy. We've preferred the special divvy in the 2 previous occasions we've done it. Okay, Sam, thanks for that.
Thank you, Sam. So we appreciate it's the holiday season for many of you, and thank you for joining us at such short notice. I'll be around during the day for any follow-up questions that you might have. And we'll also make a transcript and a recording of this available for you to view at a more convenient time. Merry Christmas to you all, and I hope that you have a good break.
Yeah, thanks everybody. Merry Christmas.